Welcome to Investoni channel. On this channel, I share with you my knowledge, my experience, and my mistakes so you can avoid making them. Alright, so you probably by now heard about cryptocurrencies, and I hope you watched my Bitcoin video where I explain pretty simple how does the Bitcoin works, what's the distributed ledger, what are blockchain blocks and miners, and how that all happening. If you don't know what's going on, you don't know how Bitcoin works, what's blockchain, go ahead, watch that video first. Highly recommend, so it would be easier for you to understand what I will explain in this video. In this video I'll be talking about Ethereum. Ethereum is the second biggest cryptocurrency by market capitalization. So I'll be explaining exactly what's the similarities between Bitcoin and Ethereum, what are the differences, how does it work, why the transaction cost is so expensive, what's the inflation of Ethereum, what's the future of the Ethereum, how does smart contract work. I'll give you an example of smart contract, and then in the end I'll compare Bitcoin and Ethereum from an investing perspective. So let's go ahead and jump right into the content. Okay, so first of all, Bitcoin and Ethereum, they are similar and they are very different. They're similar because they're both cryptocurrencies, and there's also one more thing which unites them. It's the regulatory clarity. In most of the countries, Bitcoin and Ethereum are not considered securities, so that means that you don't need a special license to trade them. And it's a very big deal, because if they are securities, then it's way more complicated from a regulatory perspective. All right, so that's what is similar about Bitcoin and Ethereum. You can send them, you can receive them. They both work on proof of work, which means that there's mining involved. Mining is running a computer to solve a cryptographic puzzle and be able to add to a blockchain. I explained it in the Bitcoin video. Okay, now let's talk differences. I'll try to explain it as simple as possible, and I like to call Ethereum a smart contract ecosystem, smart contract platform. So what is a smart contract? Smart contract is exactly how it sounds. It is a contract, and it's smart. So the contract is an agreement between two parties, right? Let's say you and me, we can have an agreement. If you pay this much money, you give me this item, right? That is a contract. We sign it off, on a lawyer with a notary. And if I pay, you will have to give me the item. And if you don't do it, then there are consequences. So that is a contract. Now, smart contract is the same thing, is an agreement between two parties, but is written in code, right? On Ethereum, you can code like JavaScript or C++. You can write code the same way you can write it in the language native to Ethereum, and you can write a contract in that language, and it will be executed on the blockchain, on the Ethereum blockchain. So there won't be third party needed. We don't need a notary to write a smart contract on Ethereum. All we need is a programmer who would write this code, and then once we deploy this code to Ethereum blockchain, then it's there, it's immutable. You can stop it, you can traverse it. As long as the Ethereum network is running, this smart contract will be running. And a simple application or a simple example of a smart contract, which I think pretty easy to understand, would be a decentralized exchange. Like, you probably know that cryptocurrencies, they are traded on the exchanges, on centralized exchanges, as I would say them. You probably already heard of Coinbase, Binance, Kraken, BitMEX, and all those exchanges. And those are centralized exchanges, which means that they have an office, they have some sort of fund, they have employees, CEO, and when you want to trade on them, you buy cryptocurrency off of them. They have their own reserves. You send them money, they send you crypto, or you send them one crypto, and they send you the other crypto. It's all happening on the back end, but they have an opportunity to stop your transaction if you're from a certain jurisdiction, which for some reason is not supported right now. They can ask you for your documents, ask you to KYC, know your customer, right? So it is working like a bank. They can always ask a question, but also the benefit is that if you forgot your password, more likely you will be able to recover it by providing some of your personal details or calling the support, and they will be able to help you because they are managing your funds on your behalf. The smart contract is decentralized exchange, or one of the applications I should say. It works different way. It's happening on a blockchain. All the transactions are happening on a blockchain. So first of all, somebody needs to provide liquidity, being this market maker. So let's say I can have a $2,000 in stablecoin, UST, let's say, and one Ethereum. I can take two of those together and put it on a smart contract. Now this crypto is locked on the smart contract and it's providing liquidity. Now then you would come with, let's say, $50 of UST. You will start the interaction with a smart contract. You can do it directly through your wallet. You don't have to register, you don't have to provide any documents. You just connect your cryptocurrency wallet. Let's say MetaMask would be a good example in the case of Ethereum. You click a button, you agree that for $50 you will receive this much Ethereum, because that's based on the current rate. You click the button, you sign the transaction, you send your $50 to the smart contract, and smart contracts returns you agreed amount of Ethereum. So that is a contract between you and the seller, and it's happening directly on the exchange. Now me, who provided this liquidity, will automatically be on the other side of the trade. So if you want to buy Ethereum, I already agreed that on the current price I'm selling you this Ethereum. So, and then my liquidity would change. I'll have $2,050 in USD and a little less Ethereum. That is a simple, I guess, easy to understand example of a smart contract. It can be way more complicated. They can do all sorts of stuff. You can plug them into real world applications. Of course, there has to be somebody who feeds the data into smart contract. Let's say you can do gambling on a smart contract. If this team wins the match, then you'll receive that much money, right? Like the gambling would give you a coefficient. Like the gambling would give you the odds of winning and losing. Of course, somebody will have to press the button or somehow connect the Ethereum part to another source of data. But the whole point is that if you already agreed to certain conditions, let's say, then you are guaranteed to be paid if these conditions are met. So nobody can say, oh, you know what, I changed my mind, there was a mistake. The code is the law in smart contracts, and as it should be. Now, you also might have heard that sending an Ethereum transaction is expensive. And why is it? Where is the money going through, and how does it work? So in order to send Ethereum or to interact with a smart contract, you have to pay a transaction fee. Now, what is a transaction fee? Transaction fee goes to the miners as a miner reward. Like, first of all, miners are getting paid for finding the blocks. That's a block reward. And then there's a transaction fee which goes on top of it. How does it work? The one block of Ethereum has a certain size, so not all the transactions can fit in this one block. Think of it as buses, right? If there are lots of people standing on a bus stop and there is one bus comes and only 30 people can fit in, but on the bus station there is 40 people, then somebody won't be able to fit in. If there's only 20 people, then everyone fits in and they go, right? In this case, the network is not congested. It happens rarely nowadays, but sometimes it does. Usually there are more people than they can fit in the bus, in one bus, so they have to wait another bus. But there's another trick, that the bus driver can sell the tickets at premium. Like, he would take the 30 people who would pay more. If you're really in a rush and you need to go somewhere right now, then you have to pay more. So you have to pay more in order for you to speed up your transaction, to make sure that it goes quickly. Now, you might say, I don't care, like, there's no rush, you just send the transaction, and if it comes in 10 minutes, it's fine. If it comes tomorrow, that's fine. There are some use cases when this is not a problem. The time it doesn't matter, right? So in this case, you don't have to pay a lot. You just pay whatever market is right now. I mean, like, back to our buses, if there are like 30 people who can fit in the bus, but you know that on average over past week there was no less than 50 people on the bus station, then you probably should pay still a little more than the base fee, because otherwise you'll just be waiting for weeks. But if you look that the average is 15 people and the bus fits 30, then you don't have to pay anything extra. Just, set it for the base fee, and sooner or later you will go. Now, there are sometimes moments when you really need for your transaction to go quick. And there will be maybe different examples. I'll give you two which are easy to understand. Right? One of them would be an exchange currency rate. Let's say Ethereum is going up really quickly right now, and for some reason you decide to hop on this train and you don't want to miss. You want to buy it at $2,000 because you believe that in 10 minutes it can be $2,200. Right? So you want to gain this 10% move in the next 15 minutes. And if you come to an exchange like a Uniswap, a decentralized exchange, every transaction, as I said, is triggering the smart contract, and every transaction is on the blockchain. So you gotta get in the block. So in order for you to make sure that you buy Ethereum at 2,000 at the current rate right now, not in 10 minutes for 2,200, you will have to pay really high gas fee in order for you to hop on the first bus is coming, to get in the next block coming. Otherwise, you might not get as good of a deal, right? And people would pay it because if they're trading on enough volume, it matters. It's okay for them to pay $100, $200 in gas if they know that they're gonna gain 2,000-3,000 or something like that, right? Another simple example would be a very anticipated NFT drop. Let's say some celebrity or something's going on, or some famous project is dropping an NFT. We haven't talked about NFTs, but you probably heard of them too. And if you want, I can explain what is NFT and how does it work. So a very anticipated NFT drop, and we know that at 4 p.m., let's say, it will be dropping, and there's a limited amount of tokens, let's say 1,000 tokens, but we know that the demand will be higher. So the first 1,000 transactions which go through will get NFT, the rest won't get anything. And if you know or you anticipate that you will earn more on this NFT, then you'll probably drop more money just to make sure that you get in those first blocks. Now that's where the transaction cost coming from, and it really fluctuates, it really depends, and it also depends on the difficulty of the transaction. And let's say to send one token Ethereum from one wallet to another is usually cheap. To send a token on the Ethereum network is more expensive. To interact with a smart contract is even more expensive. So that also matters. And the transaction cost is calculated in gas. It's called gas fees on the Ethereum network. Just like you would put gas in your car, same, you need to put gas in the transaction in order for it to go through. All right, so we talked about the transaction costs, we talked about miners. So the miners are receiving the block rewards and also all the gas which is paid by the people who are interacting with the Ethereum network. Now recently there was an update which is known as AIP 1559, and it changed the fee structure for the miners most part. Again, not to go too much into details, but the excess which is paid on top of the base fee is now not going directly to the miners, but is being burned. What does that mean? It just evaporates from circulation. It just goes to a certain address which no one can access. So it's just taking out of circulation. Let's say, imagine the US government or any other government is printing money, right? So there is constant inflation. And also in Bitcoin and in Ethereum there is inflation. Why? Because miners are being paid with new Ethereum, which is coming into circulation, right? And so Ethereum has about 4% inflation right now as we speak in May 2022. Ethereum is slowly inflating. There's more and more Ethereum coming into circulation, but there is also a burning mechanism which is taking Ethereum out of circulation. So let's get back again to our bus example. There is an anticipated NFT drop. The base fee to go on the bus, let's say, is $10, but a lot of people are rushing in and they want to pay $100. Now the miner would get $10 as it should for the work. That's a base fee, the base fee of the ticket, the base fee of the transaction, and the rest of it, the $90, which the buyer or the one who initiates the transaction is willing to pay anyways. Nobody's forcing him to. He's just willingly paying it in order for the transaction to go through, and then the miner doesn't receive it because he's working anyway for the base fee. It's a little more complicated than that, but you can get a gist of it. And this excess of Ethereum is being taken out of circulation, so there's a little bit of a deflation too. So it's again, and it's very much depends on the congestion of the network. So the more transactions going on, the higher the fees are, the more Ethereum is being burned. So on average over past few months, it was about 1.4, 1.6%, which is being burned. So the real inflation of Ethereum is 4 minus 1.6, about 2.4%, which is very good if you ask me, compared to the current rate of inflation of the fiat currency. Now, soon Ethereum is gonna switch from proof of work to proof of stake. Again, I'm not gonna go too much into details. The simple idea is that you won't need to run your graphic cards, your miners, your computers to solve the puzzle. The security of the network will be provided by stakers, validators. So super simple. You take 32 Ethereum, you lock it up on the main smart contract of Ethereum, and now you're a node, a validator node. So you will check all the transaction and put it in the network, and the validators will be randomly chosen. So it's not always you, sometimes it's you, sometimes it's somebody else, and that way we don't consume too much electricity, close to nothing, because it's all happening on the blockchain. And the incentive for you, of course, you're gonna get paid for finding blocks and for the transactions. And if you try to do something bad, like try to slip in another transaction, then you will be punished. Your Ethereum from your collateral, the one you put on the main smart contract, will be taken away, because it's all about the game theory. All the blockchains, proof of works and proof of stake and other proofs, they are all based on a game theory. You're incentivized to do work correctly, to put the right transaction on the blockchain. Because if you start putting the wrong transaction, if you just start to write some crypto on your own wallet, then it will be noticed and you should be punished. That's just how it works. You will be penalized. Probably the punished is not the right word, but you will be penalized, and some money or some work will be taken off of you. So Ethereum is transitioning to proof of stake. The event is called Merge, and it's scheduled to happen in August 2022. So we're about to see if it all goes through well as planned. Then the inflation of the Ethereum will be reduced 10 times. So from 4% it will be reduced to 0.4%. And the burning rate still stays. So assuming the network is going to be as busy as it was for the past few months, the Ethereum will start to deflate. So there will be more Ethereum burned than entering the new circulation. That's why sometimes Ethereum is referred as ultrasound money. Well, Bitcoin is sound money. Sound money means not fiat, good money, the one you don't want to spend. So Ethereum is ultrasound money because the rate of inflation is actually negative. So it's technically deflationary. And it will be interesting to see. I'm very excited for that, and so should you be, because that's going to be a historic moment for the blockchain, for Web3, and for crypto. Now we got to this point where I can briefly compare Bitcoin and Ethereum from an investment point of view. And again, I already talked about it. Bitcoin has an inflation which is dropping every 4 years in half, which is being halved, the famous halving event. And Ethereum will transition quickly to deflationary system. And I believe that inflation is being sold as a necessary, because inflation is needed for the governments, for them to be able to pay their own debt, because the government is the biggest debtor. Their debt is huge, right? So they need inflation. If the government gets a deflation, they won't ever be able, even theoretically, to pay their debt. Now, Interesting fact about Bitcoin is that there is 21 million Bitcoin ever created. Ethereum does not have a maximum market cap. So there is no cap. Ethereum theoretically is mining into infinity, but we know now that there will be more Ethereum burned than mined. So that's an interesting pivot for Ethereum network and for Ethereum fundamentals too, because the absence of maximum market capitalization was always a big concern for Ethereum holders, and was always like a conversation started between Ethereum and Bitcoin maxi, and they were looking, oh, but your coin is mining into infinity. But now it won't be a case anymore. So I think that both of them are interesting investment in 2022. Bitcoin is gold 2.0, digital gold. It has unique fundamentals, but Ethereum has unique fundamentals too. It's a smart contract platform. You can do a lot of things on it. Yes, it's maybe slow, argued to be slow, argued to be expensive, but that's the price you pay. It's the most decentralized network that we have right now. There are some other smart contract platforms. You might have heard of them: Avax, Avalanche, right? Avax, Binance with their token BNB, Binance Smart Chain, Polygon, Matic, Phantom, whatever. There are tons of them, and it's more difficult to create an ecosystem than just a token, of course. But they are all trying to be an Ethereum killer, as they call themselves, right? They are trying to compete on speed and efficiency, but in every blockchain, probably in every similar task, there is always a trilemma. It's speed, decentralization, and cost. Now, Ethereum is the slowest and the most expensive one. Then it's the most decentralized one. So you always have to find this balance for yourself. What are you willing to do? What are you willing to sacrifice? Pay a little bit more money, but make sure that it's not going to break. It's just going to go as it's written in smart contract. Or you're willing to pay less and just pray that your quick transaction will go through. So that's just a very brief explanation of how Ethereum works. I hope I made it a little more clear for you. If you have any more questions, write them down under this video. Smash the like, subscribe, hit the bell notification. I'll see you in the next videos, and don't take more risk than you afford. Thank you. See you. Bye.